this at some point will stop. And when it does, the market will go lower, and significantly so.
To me, it kind of sounds like you're saying it's a little bit out of control how influential a handful of companies are. Like my entire life, I've looked at the index, the S&P 500 index, as something that's balanced and fair and unbiased. But it sounds like it actually is kind of heavily biased, considering mathematically the way that it's calculated. So
Yes.
so then why won't they change it to something that is a little bit more fair and that isn't so misleading? Is that a concern?
No, I don't know if it's really a concern. It's just a point to be aware of. So, for example, the Dow Jones doesn't work that way. The Dow Jones Industrial Average is not market cap weighted, it is balanced evenly. It's a different form of, there's many ways you can calculate an index. One way, of course, is market cap. The value of the S&P 500 is approximately $33 to $34 trillion. In other words, if we added up the market cap of each company, it'll be $33 to $34 trillion. Well, we know Apple is $2.7 trillion, which means right off the bat, you know that that's about 8.5% of the market cap of the S&P 500. Right there, you know that. So it also happens to be greater than the market cap of the entire Russell 2000. So it's not like that's a bad thing. There is no going to ever be, I doubt, a plan to reorganize the index into something that represents more of corporate America. Years ago, the corporate America was kind of being tried. The Dow Jones, when they first formed the indice, was designed to say, what does this mean for employment? So, for example, over 100 years ago, General Motors, Ford Motor Company, General Electric represented the greatest amount, the companies that employed the greatest number of people in America. And as those companies did, so did America. So if those companies were doing bad, they would lay off people, there'd be higher unemployment, and vice versa. Today, the S&P 500 index would say, no, we'll do strictly market cap. In other words, whatever people pay for the stock will be its value, which is a fair measurement. However, I don't think the founders of this really believe that there'd be any stock that could represent so much of the market cap. And so, for example, Apple, of course, does that today. These are issues that the founders of the index never probably foresaw. And had they foresaw them, who would say that they would do things different? The bottom line, Aaron, and for everybody out there, is that there are a number of problems. Generally, a bull will say these are the wall of worry that the markets must climb before they go higher. They look at all the problems: the inverted yield curve, the unemployment rate, the inflation rate, the value of a company, is it overvalued or undervalued? They look at all the things, these budget deficit talks, the lack of leadership in the country, the various things represent the wall of worry that the market generally tries to price by going higher. It climbs the wall of worry and it falls in the sea of fear.
Mm-hmm.
So the market really, however, in this case, mathematically, it is not really going up in a wall of worry. It is not climbing a wall of worry. We are buying corporate America large corporate America, the mega caps are being bought by the largest funds out there. These are not investors. These are the BlackRocks, the Blackstones, the various large funds and money managers that represent the wealth of the country. They're just pouring their money into these stocks. This at some point will stop. And when it does, the market will go lower, and significantly so. Something always occurs to upset that. So in this case, I don't feel it's a wall of worry. I feel it is where else do I put the money?
Right.
Put it into this mega cap, or I put it into some bond or T-bill that'll pay me something very, very safe. And by the way, it's pretty safe to get on a 30-day note to get 5% on a T-bill. And you just keep rolling it. If those people out there know how to do it, you just roll T-bills, get your 5%. That's going to be sticky and you have no risk. And every 30 days, you just do it again and again until the interest rates either go higher and you make more money, or they go lower and you make less. So this, to me, is a very different scenario. I'm sure most of the people out there listening to me have heard this before. The difference, I think, here is that, supported by all the other data that, in our case, as flip users, we look at the machine learning component, and the machine learning components are not liking the market. They see things that we hear of, but they put this into a mathematical way of interpreting them. And the interpretation, of course, is not done by me. They're just largely in the pejorative. They don't like the market.